So digital asset treasury companies have been one of the most discussed innovations recently in the crypto space. And we tons of investor questions on this. Are digital asset treasury companies essential infrastructure for ecosystems? Are they just new wrappers? Will they be a critical part of institutional and broader portfolios? Here with me today, I have three experts in the space representing different digital asset treasury companies and participants. I'm looking forward to really digging in on a bunch of these topics. Let's start by introductions, and please, each of you, if you can share a bit of your backgrounds and the digital asset treasury companies that you're working with.
Great. First of all, I'm really happy to be here. I spoke at the first Coinbase Institutional Conference in New York, and look how far it has come. It's amazing, so thank you.
Thank you, Joseph.
I spent 20 years at BlackRock, my last 5 leading digital assets, trying to play a bridging role between traditional finance and capital and this ecosystem. I joined 2 months ago as the CEO of SharpLink. SharpLink is the second largest ETH treasury company, accumulating at this point about $3.5 billion of ETH over the last couple of months. And the what is very simple: accumulate, make it really productive as ETH can be, but then do incredible things in the ecosystem. And as we chat, I'd love to explain not just the what, but why. And what are the moments that matter, and why ETH as an ideal treasury asset.
Hi, everyone. Chris Ryan at Galaxy Asset Management. We manage the treasury for a couple different DATs, but I'm going to speak more on the one that we sponsored, Forward Industries, along with Jump Capital and Multicoin Capital. It's a Solana-based DAT. It was the largest pipe that was raised at $1.65 billion, with substantially all of that being deployed into Solana. I think there's space for many of these DATs. I think there's space for very few coins outside of those DATs, but it'll be a fun discussion.
Yeah, good morning, everyone. My name's Andrew Webley, and our company is called the Smarter Web Company. We're the largest Bitcoin treasury company in the UK. We listed in April 2025. We've got more Bitcoin than every other Bitcoin treasury company in the UK added together. We currently custody $300 million, which is about £220 million worth of Bitcoin. I started my career in 1999. I joined a small company that became one of the biggest companies in the UK. I was the head of online when I left 15 years ago. That company's called Hargreaves Lansdown. So then I set up the Smarter Web Company, a small technology business. And then over a period of time, probably about 10 years ago, I found Bitcoin. About 3 years ago, I started looking for a Bitcoin treasury company in the UK because I had invested in strategy, couldn't find one, which is why I decided to list my own business on the stock market, which is how it started.
Fantastic. So let's level set on what the fundamentals are. Chris, maybe kick us off with a simple definition. What is a digital asset treasury company, and what role do they play in the ecosystem?
Yeah, so we've come to this kind of nomenclature, and digital asset treasury is just putting crypto in your treasury, owning the crypto. As you mentioned, Michael Saylor really kicked this off with Bitcoin, and there was a lot of usefulness in that equity, and that there was no ETF at that point. So for us to get exposure to Bitcoin in a brokerage account, you had some inefficient trust products that Grayscale had, or you could have MicroStrategy, which was holding Bitcoin. And there was a lot of concern that once the ETFs came out, that MicroStrategy's business model would be completely defunct. And what we found is that that just hasn't played out. And there's so many nuances as to why people continue to invest with different restrictions and regulations that they have to abide by. But what we found is that, there are new opportunities for companies to acquire other types of assets. And as Joseph mentioned, these can be very productive assets. These can be yield-bearing assets. And right now, I do know in Europe and some other jurisdictions, you can stake assets in the ETFs, but that's still not available in the US. But, a lot of these digital asset treasury companies, they're not just limited to staking. There's a number of activities they can engage in which can be very beneficial to shareholders. So when I think of these as like just a treasury, it's not just cash, but it's trying to figure out how, one, we can generate some type of a yield that investors may not be able to do in another manner. Two, utilize an efficient cost of capital structure, being a public company that you don't have access to as a private crypto company. And three, really give investors an opportunity that gives you daily liquidity instead of going in a private fund structure with less liquidity, but giving you more utility and supporting the ecosystem than just a spot ETF.
Really high impact. Let's talk a little bit more, Joseph, about the ecosystem impact of DATs, of DATs. You know, what is the role that DATs play in terms of supporting a given ecosystem?
Sure. So taking a step back, Ethereum is not a monopolistic chain. It's completely decentralized. The Ethereum Foundation is not associated with a lab. So the reason why we feel very strongly that Ethereum is not only a great reserve asset, but can help bootstrap the Ethereum ecosystem is as follows. In most investment strategies in the world, the more assets you have, the more constrained you become. Like, you go to most active investors and you tell them you can give them $3.5 billion, they're going to say, stop, I have capacity limits, it's going to really hurt my returns. If you're one of the largest holders of ETH in the world, and ETH secures transactions on the Ethereum network, which right now is dominating stablecoin flows, 80% of real-world asset tokenization, and most high-quality DeFi, you can take these stacks and stacks of ETH on behalf of your investors, go out in the ecosystem, do the best diligence on every single staking, restaking, and DeFi protocol, and not only get the standard Caesar yield of 2.8%, you can get promotional yield. You can often, because you're bootstrapping protocols, get token, maybe even get equity, and on a risk-adjusted basis, generate really good returns for investors while being very, very thoughtful about the risks. Because people who I meet all want to tell me about the yield. No one wants to talk to me about smart contract risk, depegging risk,
yes,
counterparty risk, capacity, liquidity, duration. So if you do this well, and we have a partnership with Consensus, you can generate outsized returns on a risk-adjusted basis. And the more ETH you have, the higher those risk-adjusted returns can be, which is very different than other things. And in that respect, you can raise the standards of the industry. You can allocate to people who are responsible. And net-net, that's going to be really positive for our investors and actually really positive for the ecosystem. And the ecosystem needs its standards to be raised continually, not lowered.
Well, we agreed we would get a little bit spicy as we were talking about this panel. So let me key off on that a little bit. Are public market investors ready to have these different on-chain yield, crypto investments done in a public company format? And what risks might we think about? You know, Joseph, you've touched on a few here, but Chris, Andrew, maybe I can send this over to you. You know, how might investors think about this, and what might be the sort of risk mitigations that management companies need to think about here?
Yeah, I think if you look at our company in the UK as a good example, clearly private investors and an increasing number of institutional investors are ready to embrace an asset like Bitcoin through a public company structure. I think that's evident. If you look at when we listed, we became the most successful IPO in the UK ever. So yeah, they're definitely ready. I think what you have to also appreciate there, though, is that there's a lot of responsibility on the people that are involved in this industry. So if you look at the last 6 months, you had, say, 3-4 months, pretty exciting for everyone. And then what's very, very normal in Bitcoin and what we believe is very normal in Bitcoin treasury companies, into the future, you do get periods of less excitement, market corrections. And I think what we have to be mindful of is, like any new industry, so yes, Strategy has been doing this for 5.5 years. I was in New York a couple of weeks ago with Saylor, and he was talking about how this is year one of this new sector, which is certainly what I believe as well. So there's a lot of responsibility on ourselves here, everyone else that's involved in the industry in whatever way they are, to make sure that we do the right things. And, you know, without wanting to sort of name anyone in particular, I think some of the actions that we've seen this year have been incredibly short-sighted. You know, as an example, you know, we've raised an awful lot of capital ourselves. We've not done any of those equity raises at a discount. There have been some pretty big pipe deals in the UK, one in the US, numerous. And I think some of them have been badly done by advisors that have been focused on commission rather than caring about the asset. You know, I IPO'd my business because I've been investing in Bitcoin for almost 10 years. I love Bitcoin. I think it's the very best asset in the world ever. And I think with that comes some responsibility to conduct yourself properly. But that's okay as well, because, you know, as a collective industry, we're going to make some mistakes. The important thing is that we learn from them and we try and do things better in the future, because this is going to be something that we're doing for hopefully several decades at least, and then, you know, our kids and those beyond afterwards.
You know, I think when I did my first DeFi trades personally back in 2020, I never even heard of a code audit before. I just started spraying money into this ecosystem because yields were so significant and there was, you know, so much convexity in token prices and everybody was making money and it was exciting. It's a bit like gambling. And I think institutions, that's not how they deploy capital. And I think Joseph said it well, that we have to be very mindful of kind of the risk that we're taking. So I think when you put responsible stewards of capital in the ecosystem who are vetting these ecosystems, vetting the management teams, vetting the code, vetting exactly what point A is and how it gets to point B, instead of, hey, here's this earn product and you're going to get 16% yield. Well, how does that happen? Well, we can't tell you. That's the secret sauce. Well, that's the secret to it being probably a problem. I think we're finally getting to the point where institutions are looking at this with the pace of regulatory change, looking for differentiated sources of alpha that are uncorrelated to existing investments they have. And then you have the programmatic aspect of it. So first brands, like, it's a big issue now because nobody knows where that collateral is. Nobody knows if it was, you know, pledged to multiple counterparties. In a smart contract, that collateral is programmatically stored and executed on in the event of some type of a market move. You can add more collateral. You can subtract it if the value of that goes up. There is so much more efficiency and safety that can come with good smart contracts and good DeFi platforms. And I think a lot of very capital-rich companies are coming to the conclusion that it's inevitable before they start to deploy capital there. And they're going to look for the protocols and the partners that are best suited to do that.
That's a great call out. And so continuing on this theme of, you know, of market performance and considerations here, you know, I think if you look, you know, over the last, you know, emergence of the digital asset treasury sort of discourse and trends, one of the common sort of questions that you get is, how are these digital asset treasuries going to perform in a market dislocation? Mm-hmm. Well, now we've seen one just this past weekend. So let's talk a little bit about Friday's events and, you know, how the digital asset treasury space performed. Chris, maybe I can start with you. Or
sure. So if you put aside the digital asset treasuries, can we start with how the underlying assets performed? Bitcoin and Ethereum performed really well. And I'm just going to put it out there. I've been in Korea, Hong Kong, Singapore, and London, and all people have been talking about until Friday were perps. And this idea that investors in TradFi were coming to the perps markets. Anything that is on token number like 30 and below with leverage over 3x is insidious leverage garbage. Insidious leverage garbage. And people are mistaking gambling and speculation on one hand and institutions who are trying to put performing assets in their clients' portfolios on the other. Don't confuse the two. And unfortunately, lots of people lost their shirts on Friday, but it was highly predictable. You're talking about an asset class that almost every one of those assets, token 20 and below, were highly correlated. They had never been tested with liquidity. People did not even understand what auto deleveraging was. They thought they were protecting themselves by cross-margining across venues, and it just fell apart. And unfortunately, this industry learns lessons once in a while that there is a difference between speculating and investing. Just know yourself, know your customer, and if you believe 30x leverage on a meme coin is investing, shame on you, and leverage begets deleveraging. And I said it was insidious leverage garbage, and people learned their lesson, but the real investors understand where the safety is and where the high quality growth assets are. And I think these treasuries who had really good underlying treasury assets performed fine. Stocks went up, stocks went down, nothing changed.
Also, it shows how great the market's become, though. So, you know, obviously I only follow Bitcoin, but I do have a watch list of the other major cryptos, which both of your cryptos are on it. And when I saw the market come off on Friday, you know, into Saturday rebound, you know, it was actually, for me, it was a great thing to see how strong Bitcoin and all of the others looked relative to that. You know, if we had seen this, I don't know, 5 years ago, you know, we'd be talking like 50% down or whatever. So, like, obviously running a Bitcoin treasury company, you're acutely aware about your shareholders and the pain that people are going through. Everyone likes volatility upside. No one likes volatility downside. I look at the share price because my job is to raise capital. You know, when our stock is trading at a decent MNAV, it makes it very easy to sell your stock to generate a Bitcoin yield, which is, you know, our job at the end of the day. But when you step away from that and you look at how mature our industry is becoming with no government control, 24/7 trading, and you think, what, Bitcoin probably didn't even go down 10%, you know, approximately. You know, I put a tweet out this morning before I left Bristol, where I live, about an hour and a half from here, and I got a bit fed up the last few days of seeing everyone saying, oh, Bitcoin's in trouble. It's not in trouble. It's like less than 10% off its all-time highs at the moment. It's pretty good from where I'm sat, you know. Bitcoin treasuries, yes, very, very tough at the moment, relatively speaking. So I think it shows how far we've all come.
I think in finance, we're on this quest for capital efficiency. And I think on one hand, perps can be very capital efficient, but they're only as good as the centralized entity or potentially decentralized entity that you use. And perps, unfortunately, they are not a fixed price asset. They will vary, and you need to have incremental margin to be able to support those. And I kind of, when I'm talking to my family members, it's like, would you keep, you know, $5 in your checking account if you had a variable rate loan that could reprice every 8 hours? And if you didn't pay that loan, they could just take your asset, take your boat, take your car, take your house. And everyone's like, no. And I said, well, essentially, that's what happened with these perps is everybody is using these instruments to get significant exposure to an asset with a very small amount of money, but then they're taking their reserve capital and deploying that somewhere else where you might need another centralized counterparty to be able to process a withdrawal so that you can post your incremental margin. And when you get a liquidity crisis like that, everything starts grinding to a halt. And there were a number of market makers, there were a number of hedge funds, there were a number of delta neutral hedge funds that thought they had no risk whatsoever that found out that they had significant counterparty risk, and some of them lost substantial sums of money. Bringing this back to a DAT, this was actually an opportunity. We have a permanent source of capital that is in the spot tokens themselves. And there were lending desks that when the dust started to settle, they needed to borrow, they needed to hedge positions, and they didn't have the capacity to go back and perps. So we actually facilitated 2 different lending deals where the rates that we got to loan those out, anywhere from a 3-day evergreen to a 30-day term, were, in one case, it was 3 times the staking yield that they could have gotten for those assets. So this is another way that DATs can actually step in with permanent capital, support the ecosystem, and generate outsized returns that you're just not going to see again in an ETF. And a retail investor doesn't have access to generate these types of yields because they don't have, you know, those relationships, those MLAs in place, or whatever type of documentation that would be necessary to do that.
Well, it's fascinating to see these DAT use cases play out in real time. Let's switch gears a little bit to talk about exposure, and each of you have touched a little bit on ETFs. Joseph, you were formerly at BlackRock building IBIT, of course, one of the most successful ETF by many measures. And of course, now we have ETFs available in jurisdictions around the world. Great news here recently as well. Why should investors look at digital asset treasury companies as opposed to just passive access via ETFs or other access points?
Sure, and I'm super proud we chose Coinbase in August 4th of 2022. BlackRock announced a partnership with Coinbase. We broke your stock in a good way. It was an omen that institutional was coming. I was very proud to have launched the largest Bitcoin ETF in history, the largest ETH ETF in history, and they're incredible exposure vehicles. The ETH ETFs writ large have very limited capabilities to stake. And if your underlying asset is Ethereum, which is natively productive, it's very, very difficult in that wrapper to stake more than some small percentage. And the reason is very simple. These ETFs absolutely have to provide daily redemptions. They can never not do it. If you're BlackRock and you have 1,100 ETFs, you're not going to have one that doesn't satisfy a redemption. And today, with the exit queue from staking being around 40 days, 38 to 41 days, how much can you stake and still provide daily liquidity? It's just a mathematical problem and a fiduciary question. If you own it through a DAT, you don't pay a management fee. And two, we stake nearly 100% of our assets to get the full yield, and that over time compounds for investors. So these are great exposure vehicles. I launched two, and I'm not arguing against the products I launched, but the ETFs are not going to be able to stake more than a fraction, and that doesn't inure to the investors.
Mm-hmm. And Chris, what do you think? Do we see a role for a variety of different access vehicles, from digital asset treasuries to ETFs to private funds as well for investors? You look across a lot of these different vehicles.
Yeah, I definitely think so. And I think the unique thing that SharpLink has, that Forward Industries have, are you have teams that are partnered with them that are actually building in the ecosystems themselves. And it gives us a lot of opportunity to be able to not only support the ecosystem, but to try and help build that ecosystem alongside. And there are a number of different ways that we can participate by providing liquidity to different protocols, and we can get incentive yields for that. At Forward, we publicly talked about taking even equity stakes, small equity stakes. We're not a venture fund, but we think that part of supporting the ecosystem is taking small equity stakes in ecosystem partners. So, I like to think it where you could have a spot coin in your Coinbase account as a personal, investor. You could have eventually an ETF that allows staking, but as Joseph mentioned, because the amount of time it takes to potentially unstake, each issuer needs to make a really good risk assessment of how much you can stake. So whereas a DAT can do full staking, that's probably not going to be the case for Ethereum until there's different types of lending or instant liquidity arrangements out there. And then, right now you have to jump pretty much to a private fund structure. DATs are trying to find that right in the middle life where you can get instant liquidity as an investor. Well, it's not instant yet, but once we're completely tokenized and we're 24/7, it'll be instant. Right now we're market hours. But you can get exposure to a number of different yield enhancement strategies, participation strategies, ecosystem beneficiary strategies. So in crypto, there's so much ethos in the history of why you're doing this. And for many spot ETFs, the way that ethos came through from some of the issuers is we will give X% of profit to some type of a crypto foundation or back to kind of the ecosystem. Well, we're actually just deploying our capital into the ecosystem. We're helping to build it. So it's a bridge kind of between that private fund and between that ETF where if you want to trade, you can trade. It doesn't impact the amount of assets that we hold. And, we're able to continue to innovate and to think of new and creative ways to build out the blockchains that we're working on.
Great. Let's switch gears a little bit to valuation and talk about some of the different metrics that investors are using here. Andrew, maybe I can start with you because SmarterWeb has developed an interesting metric called PBID. Can you walk us through how you think about this?
Yeah, so there's lots of different ways that you can try and measure a Bitcoin treasury company or a DAT if you're considering holding or investing in one. And the one that we all know about is the MNAV, which is just a ratio between the net asset value and the market cap. MNAV is okay. It's one of the bits of the jigsaw puzzle, but we didn't feel that it was sufficient enough. So we've tried to add our own contribution to the community with PBID, which is effectively just looking at the yield that you generate. So I love Bitcoin treasury companies because the only thing that's better than Bitcoin is compound Bitcoin. And so Bitcoin yield is a way that you can show your performance in terms of what you've delivered for your investors. So in the last quarter that we've just ended, we delivered 300% Bitcoin yield, which is quite impressive. Probably the best figure in the world, actually, for a Bitcoin treasury company. And PBID basically takes that, overlaps it with the MNAV, and it effectively says, right, everything else being equal, how much longer into the future will it be until you can grow into that premium that you're currently trading at, if you're trading at a premium, that is. But then there's lots of metrics as well. So we're just redeveloping our dashboard on our website, and there's lots of other great ones out there as well, run by Metaplanet in Japan, Capital B in France, obviously Strategy in the US. And then what I'm hoping we'll see in the future is lots of the other DATs, using some of the metrics and then implementing them in their own ways for different things that they can do that we can't do.
Mm-hmm. And Chris, what do you think on MNAV or valuations in general?
I think MNAV is a really rudimentary way to value a company that has productive assets. It's like a real estate investor saying that my transaction value today of this building is $100. And what you're not valuing then is the fact that you could take that building and find 30 different tenants that's going to create a stream of cash flows into the future that will it will accrue value back to the asset. And when you're looking at smart contract, layer one platforms, these are productive assets. The other thing that I always think about is, and I ran a natural resources fund before going to Galaxy. When you look at the history of oil, it was basically, in the United States, it was found to be used for kerosene, for heating, for lighting. And there were so many use cases from cracking a barrel of oil that just weren't even known at that time. And as we continued to learn, as we continued to develop technologies and then be able to use those byproducts of oil in those technologies, oil became a more and more productive asset to one of the most important commodities, the human civilization has had on planet Earth. So we're now talking about blockchains where we are in the infancy of what we know what they can do. And these are productive assets. And to execute, on those actual blockchains, you need to have the token. It is the fuel to commit those executions and to secure those transactions. As we see activity, as stablecoins grow into the potentially trillions of dollars, as more financial institutions are onboarding crypto, as more trading markets are onboarding crypto, what we call them are essentially like gas wallets. The number of different institutions that have to have wallets that pay the gas is going to grow, and that demand for these tokens is going to grow. So we have to think about this from kind of discounting that future possibility, discounting the yield that they're generating today, discounting the growth in applications, not just looking at if I sell it today, what would that price be? Because the way that we're running these DATs is not for a quick, it's going to go up and we're going to sell it in 2 months. No, we see this as a long-term 20-year business model that has this asymmetric capability as the world really starts to embrace crypto.
Well, let's move forward from there in our remaining few moments here. I'd love to ask each of you, it's the year 2030. Digital asset treasury companies have grown as a category and are playing an important role in the ecosystem. Talk to us about what that looks like. How does this evolution happen? Joseph, kick us off.
At some point in the future, we will own 5% of all ETH, just like BitMine and Tom Lee will own 5% of all ETH. At that point in the future, almost all assets in financial services will be tokenized. I am not a Bitcoin or ETH maxi. I'm a tokenization and change the financial system maxi. Look at what Larry Fink said yesterday about tokenization of some of the largest ETFs in the world. The view is that most of money movement will be happening through stablecoins. Imagine it 10x's to 3 trillion of stablecoins in the next few years. Tokenized real-world assets are only about $30 billion. Imagine the largest funds in the world, the S&P 500 funds, the QQQs are tokenized. You're going to talk about tens of trillions of tokenized assets. DeFi, and when I say DeFi, I mean HQLA, high-quality liquid assets, lending, borrowing, market making, not the junk, not the NFTs, not the meme coins. Most of that is happening on Ethereum. 60% of stablecoins, 84% of real-world assets, and a lot of the high-quality DeFi. When institutions come in, you're going to want to own the underlying asset that secures those transactions. And Ether is the glue, the gas, the security level, and it'll end up becoming the trust commodity. So I could have gone anywhere after BlackRock or retired, which I did. I believe strongly that Ethereum will end up becoming the global settlement layer for a lot of finance. And if that's the case, Ether will be the trust commodity, the gas, the oil, as you've suggested, that will secure it. And my goal is to accumulate on behalf of investors as much ETH as possible at the lowest price in order to be really well prepared for when that happens. Like, listen to what Larry said yesterday. All assets are going to be tokenized. And he's not just talking about treasury funds. He's not just talking about common equity. And I've worked for him for 20 years. I believe he knows what he's doing. He's seeing around corners. And that will be very beneficial to high-quality debts.
Yeah, I think crypto's interesting in that it kind of started as a gambling market and is now being institutionalized. And usually we take institutional products and then we figure out how to gamble on them. So we're kind of going in reverse. My thought is that over the next several years, you're going to see real-world utility being developed on these blockchains. And I do, have a little bit of grace for the way that this has happened because the regulatory environment has made it impossible to create real-world utility on decentralized public blockchains. We're finally getting to a point where now we're seeing the regulators take a couple steps back and start to allow real institutions, real utility to be developed. And that, I think, is the most exciting change. And how DATs play a role in that is going to be very important. The other thing I'd say is that I don't think we're going to have 100 DATs. Just like we don't have, well, we do have, thousands of regional banks. But, I think of other industries, there's going to be consolidation within the DATs themselves. There were probably some that were launched for disingenuous reasons, and I think what you're going to see is that those will have a GBTC-like effect where they just cannot ever get back to even an NAV, let alone a discounted, stream of cash flows. I think DATs will be acquiring DATs. I think that's going to be something that we'll probably start seeing. We actually have one instance of that already, but in the next 6 months, it's going to become even more apparent that there are going to be DATs that continue to win and continue to operate, and then there's going to be those that just get folded up into another.
And Andrew?
Yeah, so purely answering this from a UK point of view, since that's where we're sat at the moment, I think that by 2030, you'll see that Bitcoin treasury companies and possibly some other DATs are amongst the most valuable companies in the world. For our company, the Smarter Web company, hopefully we will have ripped through the FTSE 250 and become one of the larger companies on the FTSE 100, which is our index of the 100 most valuable companies in the UK. More so than just that, what that will mean is that almost everyone in the UK will have indirect exposure to Bitcoin. through passive investments in the tracker funds. And I would go one step further, that comfortably before that time period, we will have achieved one of our other goals, which is to give private individuals a much better return than they can get from any other credit instrument at the moment, along the lines of maybe 8-9%, something like that, through the power of Bitcoin, still keeping 2/3 of the potential gain in Bitcoin for our company and therefore our shareholders. And then that will allow people to benefit from what's effectively the best asset in the world, digital capital, without taking any of the volatility risk at the same time. So that's where I think we'll be.
Fantastic. Let's leave it there. Thank you all so much.
Thanks.